I want to ask you about Trump first up, because we heard so much from that inauguration speech, and it felt as though that the US is pressing on the accelerator, trying to go faster on growth, leaving regulation behind and pivoting towards the future. And of course, we know it's a huge moment of transition. What did you make of some of the elements that we heard of?
Well, I think it's also a wake-up call for Europe. I think that also Europe needs to really focus on the economy and on growth. That's why I really appreciate and support, let's say, the conclusions that came out of the Draghi report. We need to become more competitive. We need to have more labor productivity. We need to invest more in AI. We need to invest in the capital markets union to, let's say, improve the flow of the capital in Europe. So I think many things that he says, to some extent, also apply to Europe. And the focus of Europe should be on the competitiveness of this region. And that will help the entire societies here as well.
You couldn't go to a conference in Europe last year without talking about the Draghi and Letta reports. But the reality is, after all that soul searching, nothing got done in 2024. How does 2025 look any different, and why does Trump promise to bring any change to Europe?
Yeah, well, what I do think is that indeed it takes time. And talking about the Capital Markets Union, for example, I've heard talk about the Capital Markets Union already for about a decade. But I must say that, at least for now, it is consistent, but it also requires action. And if you then talk about that, it requires integration of the fiscal policies of the different member states. It requires also, in terms of the bankruptcy laws, also integration there. It requires adjustments perhaps even on capital. So many things need to happen. The talk is good, but action will need to be taken.
What you're talking about is better regulation, more regulation. But the reality is a lot of corporates have been talking about too much regulation getting in the way. Climate change, for instance, very strong guidelines. The US has just pointed out that they're going almost in the opposite direction, stepping out of the Paris Climate Accord, taking away some of the regulations when it comes to energy policy, EVs, and of course when it comes to banking. Doesn't that mean that Europe is tied up in regulation versus the US, and that will continue to slow us down?
I agree. And so what I'm not advocating for is more regulation, but more harmonized regulation. Also when we talk about AI, so the harmonization, for example, of the AI EU Act with GDPR, harmonization of GDPR across member states, simplification of sandboxes when we invest in AI across member states. So it's more about simplification and toning down a standardization of regulation than more regulation.
Does banking regulation need to change? I mean, the US is going slow on Basel III endgame. We've seen the UK adopt the same approach, but the Europeans have not so far. Does that mean the higher capital requirements could leave Europe lacking in its ability to underwrite key businesses in Europe?
Well, in the end, it's about a level playing field. And what we see also in Europe is that there's different regulations on different elements. Talking about anti-money laundering, talking about GDPR, talking about cyber. There are differences in Europe that hampers an efficient way of banks doing business with their customers. In the end, it also has an impact on customers. And it does something to a level playing field of European banks compared to banks in, for example, the US. So that needs to change.
Underpinning this conversation is really what happens to European growth this year. And it feels like it's just going to be very slim in terms of those growth numbers. The ECB expected to again cut rates. What are your expectations, and how quickly do you think Europe needs to get back to neutral on interest rates to stimulate growth?
Well, it's not all doom and gloom. If we now look at the outlook for Europe, we see growth in Europe in some parts. We see growth in Southern Europe, in Spain and Italy. We have seen growth, and we continue to see growth in Eastern Europe, and most notably in Poland. That's outside of the Eurozone, but still. But there are still some things that need to happen. There's a lot of investments that need to be made in infrastructure. There's a lot of investments that need to be made, let's say, the strategic autonomy of Europe when it comes to tech infrastructure. Infrastructure investments in general need to be made as well. So those are things that need stimulation. In that sense, a lower interest rate will help. But again, if there is also more investments being made in the US, that could also keep interest rates up in the US, and Europe then needs to rethink or think what it will do with their interest rate, and we can't move down too quickly.
So you think the policy divergence could trap Europe in its ability to cut rates?
It may have an impact. The speed at which the US may not decrease interest rates or will keep interest rates at this level may have an impact on what is happening in Europe.
Now, I've got to ask you about banking consolidation, because we did sense last year, same time last year, that there was motivation, but it looked like there were a ton of hurdles in the way. That said, the appetite has come to the fore. We've seen efforts to consolidate. Right. If we do see some cross-border consolidation happen, where does it leave ING and any necessity to also embark upon M&A?
Yeah. Now, I've said already previously that I think there's too many banks in Europe for an efficient capital system and to flow of capital into the European economies. We need to have less banks. If I look at Europe, we are a big player in many of the markets. Consolidation, also because of the compartmentalization of regulation, I believe will largely happen within individual markets. If that is the case and if there's players coming for sale, we will have a look.